Most traders have never even heard of this powerful indicator, but the few who know about it are using it to identify overbought and oversold conditions with insane precision. What makes this indicator so powerful is that it doesn't just guess, it also calculates exactly how far price has deviated from statistical norms, giving you certainty about market extremes. And in this video, I'm going to reveal this hidden indicator to you, show you the best settings, and give you 3 powerful applications that will change how you trade forever. Let's get into it. First, head over to TradingView and pull up any chart you want. I'm using the 4-hour time frame on Eurodollar, but this works on any market, any time frame. Click on indicators and type in rolling Z-score trend. Make sure you select the one by QuantAlgo. Now, this isn't your typical overbought, oversold indicator. This is pure science. Unlike RSI and stochastic, which use arbitrary levels like 70 and 30, the Z-score uses the actual statistical formula that transforms current price into standardized scores, showing exactly how many standard deviations you are from the mean. What makes this indicator so powerful, you might be thinking first. You've got the Z-score line that shows price deviation from statistical norms, with background momentum columns showing the rate of change in these deviations. So when the Z-score reaches plus 2.0 or higher, you're looking at significant overextension that occurs less than 5% of the time. But when it drops to negative 2.0 or lower, you're seeing mathematical oversold conditions with high reversal probability. Next is the momentum columns that show you the acceleration and deceleration of statistical deviations in real time. Now, to unlock the full power of this tool, let's get your settings right. Double-click on the indicator to access the settings panel. You'll see the look-back period, which determines how many bars are used to calculate the rolling mean and standard deviation. For most time frames, I recommend setting this to 50, as this captures enough statistical data to be meaningful without including outdated information. Next, enable the info table to display real-time Z-score values. For the EMA smoothing length, I recommend you set it to 3, as this applies light smoothing to reduce noise while maintaining responsiveness to genuine statistical signals. Then, under the Style tab, enable the Show Momentum Columns option. Once that's done, click OK. Most traders struggle because they rely on random signals without a clear system. That's why we focus on structured strategies and automation, so you can study how these tools work step by step without guesswork or emotions. If you want to learn more and see exactly how these strategies are applied in real market conditions, click the first link in the description. Now let me show you 3 applications of this statistical powerhouse. 1. For statistical mean reversion. This is where the Z-score truly shines because it gives you mathematical precision about reversal probability. Wait for the Z-score to reach extreme territory, either above plus 2.0 or below minus 2.0, as these readings indicate price has deviated more than 2 standard deviations from its statistical mean, which occurs less than 5% of the time historically. But don't enter immediately. You want to watch the momentum columns for confirmation. When you see red momentum columns while the Z-score is above plus 2.0, it is a signal that the statistical deviation is decelerating, perfect for short entries. But when you see green momentum columns while the Z-score is below minus 2.0, it indicates bullish momentum building from oversold conditions. Enter your reversal trade when momentum confirms the statistical extreme. Place your stops at a 2.5 Z-score level or higher and target the 0 line, statistical mean, for your first take profit. 2. For momentum divergence detection. This advanced application uses statistical analysis to spot divergences before they become obvious. Start by monitoring both the Z-score line and the momentum columns for conflicting signals. When price makes new highs but the Z-score shows lower peaks, you're seeing statistical divergence, which means the move is losing mathematical strength. The momentum columns will often confirm this by showing weaker green readings despite higher prices, giving you early warning of trend exhaustion 10 to 15 candles before traditional indicators catch it. For bearish divergence, watch for price making lower lows while Z-score shows higher lows, which indicates that the statistical decline is weakening. The momentum columns will confirm this by showing weaker red readings. 3. For trend strength qualification. This is the most sophisticated application that separates professional statistical traders from amateurs. Use the Z-score to qualify trend strength rather than just identify reversals. Now, when Z-score consistently stays above plus 1.0 with strong green momentum columns, you know you're in a statistically confirmed uptrend. Price is maintaining positive deviation from the mean with accelerating momentum, perfect for trend-following strategies. But here's a pro tip. Use multiple time frames for statistical confluence. When both 1-hour and 4-hour Z-scores show extreme readings in the same direction, you're looking at multi-time frame statistical alignment. These setups have the highest probability of success because they're validated across different time horizons. Before I show you the next strategy, remember this: learning indicators is one thing, but applying them within a structured process is what really matters. That's exactly exactly why we've created a place where you can review these strategies, see live examples, and study them in real market conditions. Just click the first link in the description whenever you're ready to explore further. For forex pairs, set look back period to 60 for major pairs and EMA smoothing to 3. Why? Because forex markets have unique properties during session overlaps, so longer look back periods capture more meaningful deviations. Also, use plus or minus 1.8 as your extreme thresholds instead of plus or minus 2.0, as forex tends to mean revert faster than other markets. For crypto, reduce the look back period to 30 and increase the extreme thresholds 2.5. Crypto has higher baseline volatility, so you need shorter periods to capture relevant statistical data and higher thresholds to filter noise. The 24/7 nature of crypto means statistical patterns can persist longer than traditional markets. For gold, use a look back period of 40 with standard plus or minus 2.0 thresholds. Gold shows excellent statistical mean reversion during Asian sessions, particularly when Z-score exceeds extreme levels. For stocks, set look back period to 50 with plus or minus 1.6 thresholds for SPY and QQQ, because stocks have the cleanest patterns, especially during regular trading hours. Thanks for watching, and I'll see you in the next one.